Hi, my name is Judson Crawford. I'm a CPA and a partner at Cain Watters & Associates. At Cain Watters, our goal is to help our clients maximize their wealth accumulation, but do so efficiently. And in our changing tax environment, with all this new legislation, it's really more important now than ever for our clients to be tax efficient and take advantage of tax efficient savings vehicles. Now, there's many different tips that we could give you in ways to reduce your taxes and to be tax efficient. People talk about paying their kids, people talk about using vacations home as rentals in the practice, and all of those are great ways to minimize taxes. But today I want to talk about some of the big rocks, which is really tax savings vehicles that can not only accumulate wealth, but save you in taxes. Now, in order to use these efficiently, you really need to have a long-term strategic plan. Because if you don't, you're really not going to know what to do. And so the way we teach this is we're going to talk about 5 different tax environments. And if you learn to use these, you're going to get a step ahead in your financial plan, and you're going to have more money in your pocket. So the first tax environment I want to introduce to you is the corporate tax environment. You're probably all familiar with this because this is where you generate your income. Now, the IRS has many different types of entity structures that you can operate in. But you need to understand what entity structure may be most efficient for you. And there are advantages and disadvantages to each type of entity. And what's right for you is probably going to depend on maybe your practice location, the size of your practice, or how many owners there are within that practice. So whether you're operating out of a C corporation, an S corporation, a partnership, or a sole proprietorship, you need to make sure that you're operating out of the right entity. Now, let me give you an example. Let's say that you're a single operating practitioner and you're operating out of a C corporation. Now, with the new tax law, there are some advantages to being in a C corporation if one of your goals is paying down a lot of debt or making large expenditures within the practice to upgrade equipment, new build-outs, things like that. But if your goal is taking income out of your practice, this may not be the best entity for you. For instance, let's say that you're making $600,000 a year and your goal is to take all of that out for your family. In a C corporation, in order to zero out the profits and minimize your taxes, you have to take that all out in W-2 wages. Well, that causes you to have a lot of employment taxes. So let's say that instead you operated out of an S corporation. Within an S corporation, we can limit your salary to somewhere around $285 or $300 for pension planning purposes, but that other $300 can come out to you as owner distributions. Now, by changing that from salary to owner distributions, you're saving in Medicare tax and in high-income Medicare tax, which is about 4%. So on $300,000, you've just saved $12,000. So it's much more efficient in that case to not be a C corporation. Another example would be a multi-doctor practice. Many times we have clients that come in that are working with their partners and they're working out of a corporation. The problem with having a multi-doctor practice coming out of a corporation is that distributions to the owners out of a corporation have to be pro rata based on ownership. So if you're not splitting all of your income based on ownership, maybe you have a portion that's based on production, then the only way that you can make those adjustments is to W-2 wages. Now, the problem with that is that a lot of times we find that causes our doctors to have a year-end panic trying to adjust wages to make the income the way they want it to be. And oftentimes it causes doctors to have, again, too high of wages for what we want, which causes, again, too high employment taxes. So many times, if you're in that situation, we'll help a client transition into a partnership, which can be very fluid in how you split money. The second environment is the personal environment. Okay? The personal environment is where you do all your spending. It's where you travel. It's where you do things for your family and your children. This is the fun area. Okay? The problem with this area is it's not tax advantaged at all. Okay? Any money coming into this bucket, there's a hole at the bottom. It's called Uncle Sam. All right? The savings environment within this environment has both advantages and disadvantages. The main advantage is that it's liquid. It can be used at any time. You can sell assets within a personal brokerage account and use them for anything you want with no penalties. okay, as opposed to what we'll talk about later, where you have to wait until a certain age to take them out. But the main disadvantage is that the income you earn within this environment on an annual basis is going to be taxed in that current year. So between capital gains, interest, and dividends, you're going to have to pay taxes out of your earnings on an annual basis. So let's say you make 10% in a personal brokerage account in any given year. Well, between ordinary and capital gains tax rates, you're going to pay 25 to 30% in taxes on that income. Therefore, you're reducing your after-tax rate of return. And when we're talking about a long-term 10, 20, 30-year plan to accumulate wealth, 2 to 3% is enormous. The next environment is our tax advantage environment. Now, in a way, this is a subset of our personal environment because it is personal spending, but it's recognizing that there is personal spending that you do that has tax advantages, and you need to be aware of them. Examples of tax advantage spending may be your home mortgage interest, maybe charitable contributions. There's also investments that you can make that affect this, like investing in oil and gas or in conservation easements. These are things that you need to discuss with your advisor because they will affect your taxes, which will affect the amount of money you have to hopefully reinvest in other areas. The fourth tax environment that I want to review with you today is the tax deferred. This is the most commonly used savings environment for retirement, and most of the time will come in the forms of 401ks or traditional IRAs. But there are all types of different tax-deferred savings. You can use SEP or simple IRAs. If you have more money to save and you want to put more, then you can even add a defined benefit or a cash balance plan. The way that these tax-deferred savings work is that the money going in is after tax, which means that you're essentially going to get a deduction when you put the money in, which not only can help you save more, but obviously we like to minimize our taxes. The money then is taxed when you take it out, okay? Hopefully at a time later when you're in retirement and at a time where your tax rate is much, much lower than it currently is. But the best thing about the tax-deferred environment is the tax-deferred growth. Unlike the personal savings environment where we said you have to pay taxes annually, in the tax-deferred environment, you get to keep that 2.5% to 3% annually, which helps that compounding and that rate of growth over time. So over a 10 to 30-year retirement plan, this can add hundreds of thousands, if not millions, to the amount of money you have when you retire. Now, the last saving environment is the tax-free environment. Now, within the tax-free environment, you have things like municipal bonds, health savings account, 529 plans, and all of those are very good things to look into. But the main thing for our long-term wealth accumulation that we want to talk about are the Roth IRAs and Roth 401ks. Roth money, just like the tax-free money, is money that goes in after tax. So when you put money into the tax-free environment, this is after-tax money that you've already paid taxes on. But whatever that grows to over time, it can be withdrawn completely tax-free. And you get the same tax-free growth as we talked about in the tax-deferred environment. Okay? So, it's a fantastic way. The other benefit of Roth money is that there are no required minimum distributions when you reach a certain age, which means that you can let that grow for a very, very long time. In fact, it's one of the best assets for you to pass on to future generations because your heirs can inherit that as tax-free assets and let that grow for a long time in their lifetime as well. So it's really a great area if you can add this piece to your overall plan. The biggest problem that we see with our high-income clients related to adding Roth to their portfolio is that they simply don't know how to do this. For many years, there have been income limitations that say if you make over $115,000, $125,000, you can't contribute to a Roth IRA. But there are ways that this can be done. One way this can be done is by contributing to your Roth 401k. Now, if you don't have Roth provisions in your 401k plan, you would need to add this. But once you do, that would give you the ability to put your entire deferral away as Roth money. So in 2019, if you're under 50, that could be up to $19,000. And if you're 50 or older, you can do up to $25,000 all in Roth money. Now that can add up pretty quickly, especially if your spouse is doing a deferral as well into the plan. The second way is what we call a backdoor Roth, okay? Now, while the IRS says that if you have a certain amount of money or a certain amount of income that you can't contribute directly to a Roth IRA, but about 10 years ago, they removed the limitation for converting to an IRA, the income limitation. So even if you make over that $125,000 a year, what you can do is make a contribution directly to a traditional IRA and then immediately convert that to a Roth IRA. And that's a tax-free conversion. So if you have excess money that you want to save for your long-term retirement, doing a backdoor Roth conversion for both you and a spouse can add somewhere between $12,000 and $14,000 a year to the Roth environment that you may not have any money in right now. So, what do you do with all of this? Well, if you think about it, your practice, your corporate tax savings or tax environment is really where the money comes from. Okay? So imagine it's a big bucket of water, and your job is to pour that water into different savings environments or different environments for you to spend, for you to save. But you want to do that efficiently, and you need to have a plan in advance for doing so. The problem with pouring everything into the personal environment, remember, is that it has a big hole in the bottom called Uncle Sam. So you want to allocate this water out between the buckets in a manner that fits you the best so that you can be tax efficient and accumulate wealth to the best of your ability. And that's my practice inspiration today. I hope you found that helpful.